Your retirement money is funding your own country's enemy. Not metaphorically, literally. Right now, 47% of every dollar inside Canada's national pension fund is sitting in American assets. American stocks, American real estate, American infrastructure, inside the economy of the same country that just slapped 25% tariffs on Canadian steel and aluminum, threatened Canadian sovereignty, and whose currency has already collapsed 9.5% against major currencies in 2025. And the overwhelming majority of Canadians have absolutely no idea this is happening. If you have a CPP account, stay with me for the next few minutes, because what you're about to hear changes how you think about your retirement permanently. The Canada Pension Plan holds $780.7 billion in total assets, a record. It manages the retirement security of 22 million Canadians, and $366 billion of that, nearly half, is invested in the United States. Meanwhile, only 13% sits in Canada, the lowest domestic allocation in the fund's entire history. In 2005, that domestic allocation was 74%. Think about what that means. Over the past 20 years, Canada's pension managers deliberately moved your retirement savings out of Canada and into America. And it worked brilliantly. U.S. stocks massively outperformed Canadian equities throughout the 2010s. American technology companies delivered returns Canadian funds couldn't find domestically at the same scale. The CPP's own 10-year annualized net return of 8.4% was built largely on that American equity bull run. The fund generated $543.4 billion in cumulative net income since 1999. The strategy wasn't reckless. It was rational. Drop a comment below right now. Tell me which city you're watching from and whether your financial advisor has ever mentioned your CPP's U.S. exposure to you. I check comments daily, and I want to know what you're hearing on the ground. Here's where the story turns. The CPP's own official financial disclosures contain a number that should be on the front page of every Canadian newspaper, but isn't. A 10% appreciation of the Canadian dollar against all other currencies would automatically reduce net investments by $55.6 billion. Automatically. No bad investment decisions, no market crash, just the mathematical consequence of the exchange rate moving. And the US dollar has already fallen 9.5% against major currencies in 2025. Former Healthcare of Ontario Pension Plan CEO Jim Keohane said it publicly and precisely. If the US dollar weakens due to political uncertainty, it can overwhelm the returns you earn on U.S. assets. Overwhelm. That single word captures the mathematics perfectly. A U.S. equity portfolio earning 8% in dollar terms produces a net negative return in Canadian dollar terms if the U.S. dollar falls 9% over the same period. The investment performance is real. The currency loss is equally real. And this is not a short-term fluctuation. Senior pension executives are now saying on the record that the currency risk is structural, not cyclical, driven by $39 trillion in U.S. national debt, declining global demand for Treasury bonds, and a Federal Reserve caught between cutting rates to stimulate growth and keeping them elevated to defend the dollar. Something has already broken in the old playbook, and the people running your retirement know it, because here's what they're actually doing, not what they're saying in press releases. Ontario Municipal Employees Retirement System reported $1.7 billion in unrealized foreign currency losses in 2025 from U.S. dollar depreciation alone. Quebec's Caisse de dépôt spent $3.6 billion on hedging activity just to protect fund value from a falling dollar. Ontario Teachers' Pension Plan cut its net U.S. dollar exposure from $90.9 billion to $41.3 billion in a single year, slashing it by more than half, because its leadership determined the risk had become unacceptable. The Toronto Transit Commission Pension Fund is actively adding European exposure as a deliberate move away from American currency concentration. Smaller Canadian funds have reduced U.S. dollar borrowing to a 6-year low. These are not panicking amateurs. These are the most sophisticated institutional investors on the planet, with internal quantitative teams, global macro desks, and decades of cross-border investment experience. And every single one of them is simultaneously reducing their US dollar concentration right now. If you know someone with a CPP account who still thinks their retirement is on autopilot, share this with them immediately. They need to see this today, not next month. Now, here's the question nobody is asking loudly enough. What happens when $366 billion tries to move? Because reallocation at this scale is not like adjusting a personal portfolio. The CPP holds stakes in American airports, pipelines, data centers, real estate investment trusts, and private equity portfolios spanning every major sector of the U.S. economy. The Maple 8, Canada's 8 largest pension funds, collectively hold $1 trillion in U.S. assets, out of approximately $2.6 trillion in total managed wealth. If even 15% of that $1 trillion begins rotating out of American markets over the next 3 to 5 years, that is $150 billion in directional institutional selling pressure on U.S. equity and real estate markets. Not all at once, but consistent. And the effects won't stay contained to Canadian balance sheets. They ripple through asset prices, deal flow, and credit markets across every sector these funds exit. Here is the deeper problem no fund manager can solve quickly. The CPP's legal mandate, written directly into the Canada Pension Plan Investment Board Act, is to achieve maximum rate of return without undue risk of loss. That mandate contains no exception for trade wars, no clause for national interest, no provision for political alignment. CPP Chief Investment Officer Edwin Cass confirmed the fund remains a long-term investor and pointed to infrastructure assets in Mexico, Chile, Indonesia, and India as strong performers, signaling that reallocation away from the U.S. flows toward global diversification, not back into Canada exclusively. Canada represents approximately 3% of global market capitalization. The fund already holds 13% domestically, which is, by any global benchmark, already an overweight position. Forcing it higher through political pressure rather than investment merit would directly violate the fund's founding mandate and expose the government to legal challenge from the fund's 22 million beneficiaries. Finance Minister François-Philippe Champagne has begun holding quarterly meetings with all 8 of the Maple 8 funds, specifically to discuss reevaluating U.S. exposure and building a domestic investment pipeline large enough to absorb institutional capital. OMERS President Blake Hutchison said in February 2026 that the fund wants to be part of building a stronger and more resilient Canadian future. HOOP's Chief Investment Officer said the fund has capital available right now and is waiting for domestic opportunities to appear. CPP CEO John Graham said he is encouraged by efforts to build large-scale domestic projects, but pointed to what he called an opportunity deficit. The capital wants to move. The pipeline does not yet exist at the scale required to receive it. That gap between stated intention and available domestic deployment is the most underreported tension in Canadian financial policy right now. Senator Clement has called for a formal Senate review of how Canada's major pension funds manage foreign exposure, warning explicitly of risks from geopolitics and hostile foreign policy. The conversation at the highest levels of Canadian pension management has fundamentally shifted. It is no longer whether U.S. exposure is too high. It is how fast and how far to reduce it without sacrificing the fiduciary returns that 22 million Canadians are depending on. If the U.S. dollar resumes its 2025 trajectory and falls another 10% through 2026, the CPP's own disclosures confirm the outcome precisely. A $55.6 billion reduction in net investments from currency movement alone. Across all Maple 8 funds with $1 trillion in U.S. assets, the combined unrealized currency impact could exceed $100 billion. Not from a single bad decision, not from a market crash, but from exchange rate arithmetic applied to an allocation built for a geopolitical world that no longer exists. The $400 billion pension trap is not a trap because the investments were wrong. It was a trap because the world changed faster than the portfolio could. 22 million Canadians are depending on 47% of their retirement security, performing inside an economy their own government is in active economic conflict with, whose currency is under structural pressure, and whose political environment has produced levels of institutional uncertainty that Canada's senior pension executives are flagging publicly for the first time in a generation. The fund is not collapsing. The fund is not failing. But the conditions that made its American concentration a brilliant strategy for 20 years have fundamentally changed. And the people managing your retirement are navigating those changes right now, in real time, with $780 billion on the line. If this gave you something your financial advisor hasn't told you, share it with every Canadian you know who has a CPP account. This is being actively managed through the most complex geopolitical environment in a generation, and understanding it is not optional anymore. Drop your city in the comments. Tell me whether you're worried about your pension's U.S. exposure. I read every comment and I update this analysis daily as the numbers move. If you want financial analysis that connects global macro decisions directly to what happens inside your retirement account, and you want it before the mainstream catches up, subscribe. It takes 1 second, and it might be the most useful financial decision you make this week.